Yeah, hi everyone. Welcome to our week 2 management accounting, your first recording for our topics this semester. I trust this will only be round about 30 to 40 minutes, just giving us an overview. We'll do a tiny bit of revision, but most of the practical questions and things we want to achieve we'll do when we get together in our team session coming up shortly. So looking forward to that. But let's launch in and see what we can discover. Really just walking through a few slides, laying a few foundations in PowerPoint. So here we go. We're introducing cost terms. We've just got to get our heads around a few definitions and distinctions there. So let's launch in and see what we can discover tonight. We'll be looking at a cost object. What is a cost object? Try to work out the difference between direct costs and indirect costs. Also be able to distinguish between variable costs and fixed costs. And also work out when is it appropriate to use total costs and cost per unit. How would you do that? So a tiny bit of introduction to budgeting as well will appear. And we do want to also distinguish between, work out what inventoriable costs are or product costs are and how do they differ from period costs. Right towards the end, we'll be doing a cost of goods manufactured report, and there will be a couple of questions similar to that we'll do in our workshop tutorial session together. So let's start, how do we define a cost? Well, it is anything, it's defined as a sacrificed resource. It's, some funds have flowed out to either buy something, or it's cost the firm something to achieve a specific objective. So if our objective is to produce a particular item, the particular costs involved, what funds we've had to sacrifice to make that happen will be part of our cost. I don't know. Sometimes the easiest things to define are harder. But anyway, let's move on. Actual cost is something that's occurred in the past. A budgeted cost, we're predicting a cost into the future. And of course, we compare actual cost to budgeted cost to work out if we're under or over budget, if we've got a favourable variance or unfavourable variance. And a cost object is anything of interest that we're really trying to cost out, so to speak. What are we trying to work out? And whatever that is, it could be the cost of a hospital bed, could be the cost of a product, or it could be the cost of a flight path or a flight route, if you like. Cost of a meal. So whatever it is, that's the thing we focus on, and we identify the costs that are associated with that cost object. That helps us identify, and at the end of the day, we want to be able to come up with an answer. What does it cost to provide this hospital bed, or to provide, for a meal, for a wedding, banquet, whatever. And cost accumulation. Really a lot of the things we do in management accounting, some of the reports we do, are all about just gathering this data and coming up with some sort of summarized figure, if you like. A quick distinction from last week between management accounting, a bit of revision for us, and financial accounting. Remember we said last week that financial accounting is primarily reporting on what's happened in the last financial year end. So it's looking into the past mainly. Management accounting is more forward-looking. We're projecting costs well into the future, costing out, estimating costs of this strategy, research and development, new product development areas. So looking into the future, recording what's happened in the past for financial accounting. Other distinction, financial accounting, we said, is following generally accepted accounting principles. And our financial guidelines there, we've got to fit within that criteria, whereas management accounting is a lot freer. We're not governed by accounting standards. We're freer to design our reports and do our costing. We're not, there's a lot more freedom. We're not bound by generally accepted accounting principles. The third distinction is to say that financial accounting is reporting for external parties, for shareholders and for others outside the firm. Management accounting primarily is preparing reports for management, internal use. So the three areas to distinguish there. Well, what's a cost object? It could be, we're going to look for a particular car manufacturer, for example. It might be the particular brand, a particular product they're producing, but they might be wanting to focus on, let's work out what the cost is for a particular service within our facility, within our organisation. Or maybe we want to cost out a project. So all the costs that are relevant to the research and development on fuel technology will be relevant when we're coming up with reports. So the cost object helps us identify what we need to focus on and what data we need to gather. Well, let's compare now direct costs with indirect costs. Essentially, direct costs can be conveniently and economically tracked or traced to the cost object, whereas indirect costs, they can't be conveniently or economically tracked or traced to the cost object. So instead of being traced and tracked, they're allocated. So some sort of pro rata measure. So more about that in a moment. Some sort of reasonable, logical method of allocating, sharing the costs across a range of cost objects, perhaps. So how does it work in practice? We've got, for example, a direct cost of the cost of alloy wheels for this particular product, BMW. So pretty easy to track that as a material requisition comes from the production facility to the raw material warehouse saying, hey, we need 15 alloy wheels. So we can track that and record the entry for that direct material. But the indirect costs are when we've got other costs that are servicing more than this particular cost object. We're producing other vehicles as well. So the total plant administration cost, for example, we can't track that directly because there are other vehicles involved in this cost. So we've now got to share it amongst the products that we are producing. So it's allocated in some sort of logical, fair method. So the three main component parts in the production process are direct material, direct labour, labour that's used, we're directly involved in the production process. Very easy to track hours from timesheets to the product, and parts, major component parts, can easily be tracked to the product. But the third component part are our other overheads, our indirect costs, if you like. So electricity for the firm, rent, property taxes, the forklift driver's wages, security guard wages, the rates, insurance for the factory, whatever. All of these we can't directly allocate to the product. We've got to allocate them. Well, what does determine the difference between a direct and indirect cost? And it does have a bit to do with, well, how easy is it? Like what's the value of that material? Comparison here might be a little screw or a bolt for a piece of furniture versus, have you seen those bolts that are holding up the Sydney Harbour Bridge? They're massive, and they'd be several $100s perhaps at that at the time of 70 years ago, whenever the bridge was built. So it would be definitely worthwhile tracking the bolt for the Sydney Harbour Bridge, but not so much the screw or the bolt for the furniture. So the cost of the item affects whether it's an indirect or direct cost. Also, how easy is it to obtain the information and and allocate it. If it's reasonably easy, then maybe it will be a direct cost for us. So it's going to vary from organisation to organisation as to what is a direct and indirect. But primarily tonight, we'll be able to identify what the direct costs and indirect costs are. For us, really, direct material, direct labour will be direct, and all of our other overheads we're going to treat as indirect costs. Well, what does it look like? What do the total costs look like? The difference between variable costs and fixed costs. So variable costs, it makes sense that they will change in total. The more you produce, the more they will be in total. I'm just going to maybe have to pause this video for a second because I've got a bit of a cough. Won't be a moment. I do apologise. It's too hard to stop the recording and start again. So we'll just keep batting on. Sorry. So that makes sense. The more you, so if, for example, for a bus company, the fuel cost or the cost of tyres, the more kilometres we do, the cost in total will increase. We do 1 kilometre versus 100 kilometres or 1,000 kilometres. It makes sense that the total variable cost will go up. Fixed costs for the bus company again might be the rego costs, the insurance. Those sorts of costs are flat for the period. They're not going to change. So regardless of the level of activity or volume, they will stay the same in total. Now, the other thing to just be aware of is that they will only be fixed or variable within a specific activity or given period of time. So variable cost per unit will go up over time. And fixed costs, if we want to do a certain number of kilometres, we might have to buy another bus. So they'll step up. So more of that in a moment. So what about, so we've looked at the fixed and variable cost in total. What about costs per unit? So variable costs per unit will stay the same. So if it costs $5 per kilo, whether we produce for the first unit or the 10th unit or the 1000th unit, it's still costing us $5 per kilo for our raw materials or our direct materials. Whereas fixed costs will change inversely, meaning that they will drop as production increases. So let's think about that for a moment. We'll go back to the bus company. We've got $100,000 worth of fixed costs. If the bus only does 1 kilometre, the cost per kilometre is $1. $100,000 divided by the number of kilometres, 1, is $100,000 per kilometre. All the bus has to do is do 2 kilometres, and we've got $100,000 divided by 2, drops down to $50,000. And so that's going to continue. The more units, we become more efficient with our fixed costs. So this is showing us, this table is just summarising that for us, that in total, variable costs will increase, whereas in total, fixed costs won't, they'll stay the same. But what about cost per unit? Variable costs won't change per unit, yet fixed costs per unit will drop the more we produce. And this is what it would look like in a graph. Again, my variable costs here, or our variable costs, volume down the bottom here on the x-axis, dollars up here on the y-axis, pretty much a straight line. The more we produce, it's going up. And because it is a cost per unit, that's what's giving us the fixed cost per unit, if you like. That's what's giving us this straight line. Here, fixed costs in total, flatlining. No matter what the units are, the costs are staying the same in total. Well, what's the other thing we're interested in looking at in calculating variable costs and fixed costs is the cost driver. What is it that's affecting the costs over a period of time? What is it that's driving the cost up? It's normally the denominator, dollars on the top, the denominator is what's, what is it that we're going to use to calculate the total cost. So it could be machine hours that's driving the cost up. The more machine hours, the greater the cost. Could be the number of quality control tests, the electricity consumed. So cost drive is important when we're trying to cost out activities. And the relevant range is, when you see that term, it's talking about a given range. So for example, fixed costs will only stay constant or fixed within a relevant range. So the bus company, for example, and I think there's a graph coming up that will demonstrate this for us on the next slide. Yes, here it is here. So we've got a lease cost for a truck. It's $40,000 per truck, and the maximum kilometres that one truck can conceivably travel is 120,000 kilometres. So if we want to operate in this range of 120 to 240, we're going to need to buy 2 trucks. So it steps up. 1 truck can do 120,000. We step up to 2 trucks can do 240, and we'll need a 3rd truck if we want to operate at this level. So we've worked out already then that we can classify costs as either being direct or indirect. Can we easily track it to the production process, or do we need to allocate it as an indirect cost, or variable or fixed? And and they could be variable or fixed. So what can happen is you can have a mix of those. Could be direct and variable, direct and fixed, indirect and variable, or indirect and fixed. Let's have a look at some examples as to how that might occur. So let's look at the direct cost. We're looking at the particular cost object of this particular one product, the BMW X6. And certainly the tyres, a major component part of the assembly of this vehicle, can be directly tracked to the product. And if there was a supervisor who was only involved in this particular product, then it's pretty easy to cost his salary and charge it to the particular product, but it will be a fixed cost. So again, it's not going to change. We're going to pay him a salary no matter how many BMWs we produce. But of course, remember that the more BMWs we produce, the cost of this fixed cost per unit will drop. What about our indirect costs? So what's going to be variable? The electricity costs running the machinery to produce the BMW X6. The more we produce, the longer hours we work this plant for, the higher our costs will be. But still, there may well be other vehicles being assembled than the BMW X6. So we're going to have to share the electricity cost amongst the products that are produced. Fixed costs that are indirect would be the annual lease cost of the plant. Again, we're producing more than one product, so we've got to allocate it. This lease of the plant may well be used for, as we said, other vehicles. So we're going to have to allocate it, share it in a logical manner amongst all of the products. We can't track it directly. We will spend a bit of time when we get together for our workshop just walking through, being able to identify of these a range of costs, just getting familiar with being able to identify whether these costs are fixed or variable. So we'll do this activity when we get together in class. There's the answer to it. One of the nice things about being able to identify split your variable costs and your fixed costs is it does help when it comes to budgeting. So if we've worked out our total fixed costs of $2,836,400, and we've put all of our variable costs together, and we've worked out that the cost per shoe is $12.68. It makes it very easy when it comes to budget then at a range of level of activities. At 100,000 units, shoes, it's going to cost the flat fee of 2,836 plus 100,000 at the variable cost. So 4,104 all up. If we're running at 200,000 shoes, again, the fixed cost plus the level of activity, 200,000 at $12.68. 5 million is our total cost. So it does help us with when you're coming to do your budgets, good idea to work out your fixed costs in total, hold those, and then of course just multiply out your variable cost by your volume or quantity level, and you've got your total costs. Notice the cost per shoe is dropping. We get the total cost divided by the number of units, $41 per shoe when we're running at 100,000 shoes, versus 5 million divided by 200,000. When we're running at 200,000, we're running at our costs of $26.86. So that's because we're becoming more efficient with these fixed costs. We get a range of questions too when you get a level of activity. So here we've gathered some data for when we're mowing 2,000 lawns versus 3,000 lawns. And what we can see is it's very, very easy to see that if the cost didn't change as activity went up, then clearly the salary to the owner is a fixed fee. So anything that stays the same, depreciation on the lawnmower is a flat fee. It's not going to change, nor is the advertising cost. But if a cost is in direct proportion to the number of units. For example, we'll have a variable cost. If it doesn't go up, it's not fixed, but it's not fully variable, then it's a semi-variable cost. It's got a little bit of a fixed component in there. So let's have a look at a fully variable cost, 24,000 divided by 2,000. We've got $12 per lawn at this rate. Let's do the same here. 36 divided by 3 is $12 per lawn. So there is a totally wages paid to lawn cutters is a variable cost. But if there is a cost somewhere, we'll go to the next slide, for example, we might have a mixed cost or a semi-variable cost where it doesn't exactly go up at the same ratio. If we divide 30,800 by 2,000 and 41,300 by 3,000, if it doesn't work out to be exactly the same, then we know that there's a little bit of fixed component in there. So possibly it seems that as we're driving around, when we do more lawns, we don't have to drive as far and we don't use as much fuel. That's what that is telling me anyway. So we've already identified that really to come up with the unit cost, all we need to do is work out add up all of our costs. We'll have total costs. And we said, of course, those total costs made up of fixed cost component and variable cost component. But get the total cost, divide by the total number of units, and of course, you've got a cost per unit. This slide is just reminding us that we've just got to be a little bit careful. Remember that unit costs for fixed costs will change. So it really needs to be, if we're talking about unit costs, we've got to lock it into a particular level of output or activity because it's going to change as the output or activity changes. So sometimes we'll work in total costs and sometimes per unit cost. It just depends on the question and the nature of what we're doing. We're just going to look at the concept of inventory or inventoriable costs versus period costs. Essentially, period costs are written off against the revenue for the period, whereas product costs or inventoriable costs are charged to the stock or they're really an asset held in inventory until the time they're sold. Once it gets matched against revenue, it becomes cost of goods sold, but you can carry forward costs into future periods if the stock is unsold. The other thing that's interesting to point out is, for example, with a service sector like an architect, you can bill his hours and his wages, but time, unlike stock, you can't stockpile time. He's only got a certain amount of hours in the day, and he uses it up, and you bill the clients. You can't store it and carry it forward into the future. So you'll be, he's certainly not an inventoriable cost, if you like. So in terms of stock then, or inventory, we've got 3 types of inventory. The raw material component parts. Think of the Bunnings warehouse perhaps, and all of the, imagine they were the raw material component parts for a particular industry. And so you've got this warehouse that's you can control the stock you need. And the reason you need a reasonable stock in your raw material warehouse, of course, is you don't want to be, you've got to make it efficient as you're producing stuff. So you don't want to have to be, this guy says, hey, I need, 3 kilos of whatever, material X. You don't want to be on the phone and he's got to wait 5 hours, people sitting around in the factory with nothing to do. So we really do need to maintain a reasonable level of raw material component parts. And then once it's shipped into the factory, there'll be some journal entries we'll walk through in a moment or two, and in the next few weeks as well. But this stock is decreasing once it disappears out of the raw material warehouse, and it's becomes part of work in process stock or work in progress. And labour is added, overheads are added, and this stock level, the cost, the value of this asset is increasing. Work in process and work in process or progress is often abbreviated as WIP, work in process. And but the moment, of course, once it's finished, you're not going to leave it lying around in the factory. You'll run out of space. So once it's completed, ship it out to the finished goods warehouse, and it becomes finished goods stock ready to be shipped to the customer. So these are the 3 main component parts: direct material, direct labour, and all of our other manufacturing overhead costs, indirect manufacturing costs, manufacturing overheads essentially. So those 3 costs become product costs. They get tracked and traced and attached to the product. And it's not until they become cost of goods, when they're sold, they become cost of goods sold and charged against the revenue, matched against the revenue for the period. Period costs can't be carried forward into the future. They're written off. So your normal operating expenses down in your revenue statement are period costs. A couple of other definitions to get our heads around. One is prime costs and conversion costs. Sometimes you get a question that says, I want you to calculate the prime cost. So we need to know what that is. And sometimes it'll say, what's the conversion cost? So let's identify those 2 things. Prime cost is basically our direct labour and direct material. So direct labour plus direct materials equals prime cost. Conversion cost is the cost of converting the raw material. So remember, there's 3 costs in the production process. I think they're there. Direct material. So here's my prime cost made up of that and that. And then of my conversion cost, it's not the cost of the material. Of course, it's the cost of converting it, or what costs are involved in converting these raw material component parts into work in process and finished goods. And the answer is direct labour and factory overheads. So there is our definition for conversion costs: factory overhead costs and direct labour. I think we've talked about that, so I won't labour, that one. So we're nearly there. We've just got to work through this flow of costs through to what does the cost of the goods manufactured statement look like, and where do things end up? And obviously, if it's stock, it'll end up closing stock will end up in the balance sheet as an asset. So this will end up in the balance sheet. Closing balance of work in process will end up in the balance sheet, and also closing balance of this stock will end up in the balance sheet. But as costs are finally goods are sold, they'll get charged against the revenue. So let's track the costs through the process, see how we go. So we've got, think about raw material warehouse. We've got opening stock of $11,000, and we've purchased in ordered in $73,000 worth of material. This, as perpetual stock recording suggests, we want to track costs all the way through the system. So we will debit this asset, increase asset, debit raw material, direct material inventory, if you like, and 73,000, and credit accounts payable. So asset increase debit. This when it's transferred out, the factory supervisor says, hey, I need some materials, sends a requisition away, and material is transferred into the factory. So remember, whatever stock you started with, plus what you've purchased, minus whatever's left in the raw material warehouse must be, the balance must be what's been transferred out to the factory in work in process stock. Then where other dollars are being added, value is being added to work in process through the timesheets. As labour is charged, we're debiting the asset account. This value again is increasing, so we're going to debit work in process stock. Also, manufacturing overhead costs. So those things that we talked about, the rates, the rent, the forklift driver's wages, the security guard, the supervisor, all those sorts of costs being allocated to work in process stock. Those three component parts, the 76,000, the 9,000, and the 20,000 add up to 105,000 total manufacturing costs incurred. We're going to track that in the report on the next slide in a moment. But let's again track further through the system. We've got opening stock of work in process of this, plus we've got these costs flowing through of 105, minus whatever stock is on hand at the end of the period. The balance must be the value of stock that has been completed and transferred out to the finished goods warehouse. Again, you'd be used to this from accounting one, that in your revenue statement, you go, hey, opening stock of finished goods, add, now for your retailer, it's add purchases, but for us, it's the cost of goods manufactured being transferred in. So 22,000 plus the 104 minus the 18 must be the value of the 18 of stock on hand at the end, must be the value of costs that have been sold through the period by default. And we'll work through to get our operating statement. So let's put it together and see what the cost of goods manufactured statement looks like. Name of the firm. It is we're accumulating costs for a period. So it's not like the balance sheet as at, just like the revenue statement, it is for the year ended. So costs build up through the period. And there it is, our calculation of openings. So the three main component parts, the shell of this is materials, direct labour, and factory overheads or manufacturing overhead costs, the three main component parts. Well, with our material stock, we've got opening stock, add purchases of direct materials, less closing stock, must be the value of stock transferred into work in process. There it is, the 76,000 coming in. Then we add the value of, per the timesheets and hours times wage rate to get the direct labour charged for the period. And finally, accumulate all of our overhead costs, manufacturing overhead costs. They came to 20,000. So those three items add to 105. So we're now up to this stage of trying to work out what this 104 is, the transfer to finished goods. And of course, it is opening stock of work in process plus the 105 minus closing stock of work in process is that 104. So that's what's happening here. We've got the 105 total cost coming in from materials, labor, and overheads. Then add opening stock at the beginning of work in process minus any work in process still in the factory at the end of the year. And that's the value of goods transferred out, the cost of goods manufactured transferred out, 104,000. That gets transferred into our revenue statement. Income statement for the year ended, we get our sales revenue, then less cost of goods sold, beginning finished goods stock, 22,000, and then this value of cost of goods manufactured transferred in from the previous slide, 104,000, minus closing stock of finished goods of $18,000 gives us the cost of goods sold. Sales minus cost of goods sold gives me my gross profit. Then go looking for any of my other period costs, my operating costs, marketing, admin costs, and add them all up. And so they come to 70,000. Take them away from the gross profit, I'm down to my operating income or net profit. So when we come together for our workshop session, we will get used to producing these. We'll probably set it up in Excel, and we'll produce our cost of goods manufactured, and we'll also then produce our income statement, bring that cost forward. But that's probably enough for us today. It's good for us to be just the main things to be able to identify is what is a cost object? Can we identify a variable and a fixed cost? And can we, at the end of the day, we want to be able to produce one of these costs of goods manufactured. So we'll stop the recording there, and I will look forward to seeing you soon.